On today's Hot Sheet, I'm discussing Fannie Mae's Consumer Sentiment Report for December 24, the Job Openings and Labor Turnover Report, ADP's Employment Report, as well as mortgage application data for the past week. Today is Wednesday, January 8, 2025. I'm Byron Lazine, and the Hot Sheet starts now. All right, welcome back into the Hot Sheet. Let me know in the live chat which market you are tuning in from. Haley, you got any issues over there besides that Eagles sweatshirt that you're wearing today? No, you good? I'm good. I can hear myself. Yeah. All right. Haley's in today for Bobby. She started jumping around there for on me and distracted me, and she'll never be back on the Hot Sheet again if she continues to wear Philadelphia Eagles gear. And we'll have to send her to Tom Toole's office in Philly if she wants to keep wearing Phillies gear. All right. Anyways, we've got a whole bunch to get into here today. Newsflash: tomorrow, markets are closed. So to stick with our consistency, the Hot Sheet will not run. Day of mourning for Jimmy Carter. So we are off on the Hot Sheet tomorrow. We've got a lot to cover here today. It doesn't look like there's going to be much tomorrow unless there's something breaking. I could always go breaking live if something were to happen. But we do have a bunch here to fit in today on the last Hot Sheet of the week, including how consumers are feeling in December. Is the consumer confidence moving up? Do they feel like, this talk of a tailwind, this talk of a better economy, this talk of, everything that potentially can happen post, January 20th with how people feel about the economy and all of that. Is it showing up in the data of December? Of course, December, Fannie Mae had a whole month post-election when you look at consumer sentiment and the sentiment specifically around housing. Are people feeling better about the 2025 housing market? At least that 30-day sample was a couple weeks past the election and all of that. So let's jump right into that. Number one, first thing is the mortgage optimism is the primary driver of year-over-year improvement. Seems odd, right? That mortgage rate optimism would be the primary driver of year-over-year improvement. I mean, if we just go over to Mortgage News Daily and look at where the rate is year-over-year, right? If we take a look at beginning of 2024, we were in the 6 3/4 range. Okay, a year ago today, we were at 6.74. Okay, and if you actually look back if we took this all the way back to December, because remember this is a December report. By middle of December in 23, we came down to 6.65. We started December similar to where we are right now, interestingly enough, before the decline mid-December. We started at 7.09, which interestingly enough is exactly where we are today. Again, this is January. So January, we're at 7.14. But if we go back to, where we started December here in 24, we were at, 6.86. Okay, so we don't have numbers that are that dissimilar between December of, there was flexibility in both Decembers. Okay. We started, close to 7% at the beginning of December. We saw that that one moment of time in the first week of December, where we got down to 6.68, but we ended December up over 7 with fears that this 10-year is going to move even higher, with fears that the 30-year fixed can move even higher earlier in the year. And last December in 23, we saw a lot of volatility as well. We saw 7% to start. We saw it down in the 6.6s, just like we saw for a brief moment this past December. And then by, beginning middle of January of last year, we were into starting to creep up into those 7%. So both Decembers, were a range from getting down to 6.6, longer period of time at that range last December than or 2 Decembers ago, 23, then December 24. And then, periods of time where we're up closer to 7% more at the 7% level this past year than we saw in 23. Yet, despite that, consumers just feel better. Okay, the numbers are the same, but they just feel better. They have more optimism on the mortgage rates and where they might be heading throughout this year. Okay, interesting. Overall, the home purchase sentiment decreased 1.9 points in December to 73.1. It did remain substantially higher, though, than year ago levels. Okay, and this is all correlated to this mortgage rate optimism. All right, with December's. This is the thing. Consumers continue to expect that mortgage rates will decline over the next 12 months. This is one of those that I want to be there. I want to be in the boat. Okay. I get on a boat maybe once a year when I'm down in the Virgin Islands, when I'm visiting my favorite place in the world, St. John. I want to go visit some British Virgin Islands. I want to be on the boat for a day. I want to have my people with me. Like I want to be with wherever that cruise ship is that all these, buyers are, drinking the Kool-Aid of optimism. I want to jump on that boat with them. I want to be along for the ride. I want to go tour some Caribbean islands, and I want to be, cheering on this lower interest rates to decline over the next 12 months. When we look at what the consensus is over a variety of, forecasters, it's not like we're going to get, a huge movement on the 30-year fixed if all of these are even, if these are even accurate. If this is the average here, we're going to get down to like 6.4. You could, housing market has got us going as high as 7.25. Mortgage Banker Association 6.4, Fannie Mae 6.4, Realtor.com 6.3. You've got NAR at 5.9. I talked about this on Knowledge Brokers podcast. I mean, to me, that's I don't even understand that one. I don't know how they came up with that, because some of their other projections counter this number. They have home prices going up the least. Well, if you have 5.9%, do you know how many people are going to be, bidding on homes? So their own projections counter each other. I throw that one out. I could throw the 7.25 out and the 5.9 out. And when you average these out, we did this on Knowledge Brokers podcast on last Friday's show. The average was 6.34 across. It was 10 plus models that we used there. So, we're at 7 and an eighth. We moved down to 6 and 6.34 in a best case scenario. If the average hits, and that's really what buyers are, waiting for. This is what buyers are in, and this is where the conversation with buyers really needs to be detailed. You need to pick through all of the dead layers of skin that a buyer might have, muddying their thoughts, clouding their vision, because somebody's told them, hey, the rates are going to move down. Just wait for the rates like everybody else and for the competition to come out. So sentiment moving down a little bit, not that big of a concern being the month of December. Interesting to note that the housing sentiment moved down the first full month after the election. I think that's interesting. Year over year, much higher than where it was last year. What's interesting to me is the reason why it's much higher than last year. It's this mortgage rate optimism. It's the belief that too many buyers have that we're going to have, a better mortgage rate environment if we wait. History tells us a different story. Okay. Here's a really interesting, and we talked about this a little bit yesterday, but we didn't have one that went all the way back to 1971. Here's a table that goes all the way back to 1971, the U.S. mortgage rate, the average rate. Okay. Look at this. 70s, we're talking between 7.5 and 12.9. Okay. The 80s, I mean, you're talking 15, 17%, 13, 13, 13, 11, 9, 10, 10, 9. The 90s, 9s, 8s, and 7s. The 2000s, 2000 to 2010. The lowest it got was 4.9 2010 in a massive recovery from the great financial crisis year. All of these years, 2008 when we were at 5.1, all the way to, I'll drag that out to 2019. That decade was recovery from the biggest financial crisis of all time. And that's why crisis-like events create these low mortgage rate environments and the amount of money that we printed. Okay, 5.1, 5.1, 4.9, 4, 3.4, right? We get it. These were low numbers. And then you have another crisis that drove it down even further, 3.7 or 2.7 rather in 20, 3.1 in 21. And now we're at the 6.4, 6.6, 6.9 range. It certainly appears like we're going back to what the historical times would suggest. Another interesting thing is, hey, this is a first time since 78 to 81 that we've seen mortgage rates not improve for 4 years straight. Okay. So we've rose the mortgage rate for 4 years in a row. It's only happened one other time. Okay. Now that could be a cause to say, oh, maybe the optimism should be there. We've never risen on the 30-year fixed mortgage rate 4 years in a row. You got to go back to, 78. You could actually throw 77 in 77, 76 in there. They really rose 6 years in a row. 76, 8.8, 77, 9, then the 10.4, 12.9, 15, 17. So there's evidence that you can go up 6 years in a row, but it's only happened once, going all the way back to 1971. If we go back, you could include 2020. We've really actually gone up 5 years in a row. So looking at that, we might have a sixth year. It's happened before where the U.S. mortgage rate has gone up 6 years in a row. 2025, you could see it move from 6.9 average to 7 and an eighth. Would you be shocked? I wouldn't be. And would you be shocked if the improvement afterwards isn't that substantial? I mean, 81 was a bonker year at 17, but look at the improvement after it stopped moving up. It kind of went back to the average between 79 and 80, 13.6, 13.4, 13.1, then down to 11.1. Okay. If you go back to, if it moves down and goes back to the average of 2022, which is where projections are, okay, we don't go up for a 6 year in a row, but we go back again to where the projections are coming in, 6.4. There's not a lot of evidence to support for a buyer that the 30-year fix is about to go significantly down in 2025. Yet the sentiment believes that mortgage rate optimism is something that's pushing them more so than this same time last year. I would caution agents on allowing clients and consumers to hold on to that belief. The longer they believe in fairy tales, the more they're going to push out an opportunity that could be right there in front of them. 73.1 comes in on the overall HPSI. Buying conditions is up 9 year over year, but down 3 month over month. Selling conditions is down -2 month over month. Home price outlook down -1 month over month. Mortgage rate outlook down -4 month over month. Job loss concern down, and change in household income is the only thing that's up +1. So first full month post-election, consumers, when they look at the housing market, not feeling as good as they were in November. Something interesting to note there, okay? Still 78% say bad time to buy. 22% believe it's a good time to buy. And when you're looking at selling, 63% believe it's a good time. 36% bad time. And all these charts will be available for you. And, BAMX members, you can grab this stuff in the hot sheet show notes to use. Home prices going up. 38% believe that'll be the case, while 27% believe it'll go down. 35% stay the same. So consumers relatively are mixed on where prices will go. And I get that, because listen, if you're asking me about where prices are going to go, first thing I'm going to say is, are we talking the Gulf of America the Gulf of Mexico? Anybody see that? Maybe a new branding there. Would Gulf of America get those shoreline properties to go up or down in value as opposed to the Gulf of Mexico? But are we talking about, properties surrounding the Gulf? I think a lot of those properties might be going down in value. We're talking Southwest Florida. Yeah, I think there's a lot of evidence that you're going to continue to see movement down or sideways on price. Are we talking, inventory starved locations like the Northeast or parts of the Midwest? I really can make a strong case that prices continue to go up in a significant way. So, consumers are confused there. And I think that's going to be a very micro conversation. Employed residents concerned about losing their job in the next 12 months. You've got 3 out of 4 just not concerned about that. Household income compared to 12 months ago, about the same, 70%. So not a big concern there. Expected percent over the next 12 months here. This is rental prices. Okay. So they expect rental price to go up 4%, home price to go up 0.4%. Respondents who say rental prices go up in the next 12 months, 57%. Okay, there's some of the thoughts for consumers in the final month of 24, the first full month post-election, how they're thinking about it. The big one there to me, again, is how are people actually thinking about this mortgage rate? And are they making a decision on trying to time this mortgage rate? We can just go back to the last 30 days. We can go back to December. We had that one day at 6.68. If you locked in on that one day, you were really, you should have been really happy with your decision as a buyer. But there was a lot of other days where it was up over 7. Okay, if we go back 50 years, this is the average fixed mortgage rate. It's 7.75 over 50 years. The 30-year fixed rate is 7.75. 3.5%, they're just not going to come back. Okay. So we're really waiting for 6.5, as opposed to just doing, let's have a conversation about the buy down. Let's have a conversation about where your personal financial situation is to lock in at 6.5. You can lock in at 6.5 if the rates are at 7. Banks got that kind of flexibility. And we're in January. You got more negotiating power than you do in March, than April, when everybody thinks it's the best time to buy and they're competing against everybody else. All right, let's move over to job openings, see what's happening there. Job openings and labor turnover were little changed on the job openings at 8.1 million. And that was down 833,000 over the year. So when you look at the month of November versus October, you don't have much of a change. This is U.S. Bureau of Labor Statistics. But when you look year over year, there's less job opportunities in the market than a year ago. I think this trend continues, more so because of AI, right? Like I think there are businesses that are still in growth mode, but there's a lot of, you've got 12 more months now compared to the beginning of last year of these AI. I'm not talking ChatGPT. I'm talking all, there are dozens upon dozens upon dozens of great tools. Last year, Gemini was supposedly woke. This year, Gemini is being coined as like one of the best AI tools out there. In 12 months, that tool has become very useful for a lot of people. There's a lot of video editing and other tools that are very useful. We use them at BAM. We've drifted away from Slack inside of BAM to a product called Glue. We're beta testing Glue, which is the AI competitor to a Slack. There's all of these tools now that when maybe somebody leaves a company or you move on from somebody at a company, say, am I going to replace that person, or can we be more efficient by using some of these tools? So I think job openings could continue to be on the decline this year. You do have an economy that feels pretty tight with where the rates are and the restrictive policy. And you've got a lot of tools that are just, allowing for, business owners and decision makers at businesses to say, maybe I don't really need to go out there and make that hire. Maybe we can get better with the tools that continue to get better around us. ADP also has a jobs number that the private sector employment increased by 122,000 jobs in December. This missed, okay? This number was a miss. So another sign that the job market continues to slow a bit. 122,000 jobs in December was less than expected. Okay, you had 146 additions in November. You only had 122 for December. And you had a consensus from Dow Jones that they were forecasting 136. So you got a 14,000 miss there. Wages grew 4.6% from a year ago. 4.6% would be the slowest pace since July 2021. All signs are pointing towards a continued job market that is slowing down. 10-year didn't I guess get any of that data today. We were up by over 4.7 earlier. We're at 4.697. So job release, we were up over 4.7 just before at the job release, and now down to 4.697 on the 10-year. Hopefully, I'm not rooting for a break in the labor market, but hopefully there is something that can start to push this 10-year down. All right, let's take a look at mortgage applications quickly, because I think this is kind of a throwaway week. We had really 2 holiday weeks that really dragged out this year, with the holidays being on Wednesdays. Mortgage application on the top line decreased 3.7% according to Mortgage Banker Association. This is for the week ending July 3rd. Okay, so you've got the July 1st holiday. It includes an adjustment for that New Year holiday. That 3.7% adjusted from 1 week earlier, and 47% increase from the week earlier. The week earlier was obviously Christmas holiday week. So, that's a throwaway stat. Refinances increased 2% from the previous week, 6% lower than the same week a year ago. Big number we care about here is what happened to purchases, if we're going to care about anything in this particular week's report. And that decreased 7% from the week earlier. And the big one I want to look at is what happened from week over week, same year, 15%. But the holidays didn't match up exactly. So that is what it is. We're going to look more closely at next week when we go January 3 to January 10 data, and what happened with mortgage applications there. One thing that can slow mortgage application down when we're looking at a time period when they usually get your most mid-January into February. Most mortgage applications for the year come in that 4-week period. One thing that could slow that down is the fact that we're dealing with an elevated 30-year fix at 7.14 compared to where we were just at certain parts of quarter 4 and quarter 3. 7.14 is where we ended the day. That was yesterday, up from Monday. All right, there you go. There's your hot sheet for the day. Certainly, if you are new to the BAM YouTube channel, make sure you go ahead and just hit subscribe and the notification bell. BAMX members get access to all of our hot sheet show notes each and every single day. This is how we come up with all of the data for the shows. It's broken down in segments. You could use these segments for your own local show if one of these segments makes sense as a tie-in to you going from macro to micro, as well as many BAMX members using this content in their communications, text, and email. Just copy, paste, use it. Obviously, it's available for you along with all of the charts and data, all inside of BAMX, to make it easy for you to sift through the noise and get access to what you need in a 24-hour window of communicating and educating your clients. BAMX membership can be used. Use the link down below and use code HOT to get the discount there. BAMX members, we have office hours today, 3:00 Eastern, live inside the community. I will be hosting that along with the CEO from Zudilio. Kayla is going to be joining me. How to get started here in 2025, what people are doing to generate more listings, and specifically how Zudilio is helping BAMX members get more listings. All BAMX members get a Zudilio platform completely included in being a BAMX member. Zudilio platform alone is a $1,200 value a year, $100 a month value. BAMX on its own, it costs a fraction of that. Check out the link down below to get your BAMX membership so you get Zudilio included. Again, we're having a BAMX office hours at 3:00 today, so I hope to see you guys all there. Hope you guys have a great Wednesday. Until next hot sheet will be Monday, because tomorrow markets are closed, so we will have no hot sheet tomorrow. We do have a Knowledge Brokers going up Friday. On this channel, we'll have a walkthrough pod. Obviously, on Thursday, Knowledge Brokers over on its own channel. Real Word released yesterday. So a lot of content to catch up on, obviously, for you guys. And we'll see you on the next hot sheet next Monday. Until then, of course, toodaloo.